All right, listen, day one of the boot camp. Okay, I'm going to be going through the foundational elements of the market, how the market works, how it moves, the things that we need, and only the things that we need. Okay, it's not going to be filled with fluff and all of this extra stuff. Okay, so this is going to be very straight into the point. Um, and we're going to move forward. We're going to move through these concepts. I want you to take great notes on the things that I'm saying and the things that I'm sharing. You will get a copy of the recording from the boot camp, day one, day two, as well as the recordings over the next month as we partake in these live trading sessions together. Okay. So, first things first. Okay. There's only three things that you can control in the market. Okay. There's only three things that you can control in the market. Everything else outside of those three things are what outside of your control. So, me being 15 plus years in the game, I'm constantly improving. I'm constantly working on my trading, right? And how do I do that? Okay, I do this by focusing and fine tuning the things that I can control. Okay, I can't control the variables of the market. Okay, but I can control one where I exit. Okay, my exit, your exit is the most important part of trading. Okay. Your exit is the most important part. Why is the exit the most important part? Think of it this way. Okay. If you were to take a road trip, okay, or if you were to book a flight, okay, you book a flight based on where you want to go, where your final destination is. Okay. So we never get into a trade without understanding or having an idea of where our exit is. Where are we looking to go? We're not just looking to buy. We're not just looking to sell. We're not just looking for the market to go up. We're not just looking for the market to go down. We want to clearly define our exit in the market. The second thing that we can control is where we enter the market. Okay. Where we enter the market. And the third thing is how much you risk. Okay. Today, we're going to cover the foundational elements of the first two parts of it, where we exit and where you enter. Okay. Tomorrow, day two of the boot camp, we're going to cover how much you risk. Okay. And we're going to tie all three of these elements together to develop a professional and sound trading plan that you can refine to make your own. That's going to put you in a position of knowing that you have a sound process as you approach the market on a daily basis. Okay. So, again, the three things, the most important being where you exit, where you enter, and how much you risk. Okay. We understand these are the only three things in our control. Now, understanding that, right, we need to be able to understand what is the purpose of the market. Okay. What is the purpose of the market? If you think about any market, the grocery store, the car market, the cow market, the shoe market, the fashion place, right? The purpose of any market is to do what? Facilitate trade. Okay. They want to facilitate, and we want to facilitate trade between what? Buyers and sellers. Okay. We want to facilitate trade from buy between buyers and sellers. The market works the exact same way. Okay. It works the exact same way. Now, understand who controls the market. Okay. It's the banks, the institutions, the larger firms that can move the market at the click of a button or the click of an algorithm, right? Um, these are the people that control the markets, right? So when you understand or you know who control the markets, now it's time to understand what is their purpose of controlling the market. Okay. And their purpose of controlling the market is to make as much money as possible. They can move the market as high as they want to. They can move the market as low as they want to. They can consolidate the market for as long as they want to, right? But the ultimate purpose of the banks and the institutions is to do what? Make an infinite amount of money. Okay. And when we think about the amount of money that's being made or the money that's being made, the money that is to be captured is that of the retail trader or the less informed trader in the market. Okay. They're looking to facilitate trade with what the retail customer or the less informed, right? The same way, just like the mall, right? Think about retail shopping, right? You go to the mall. Um, these stores are looking to facilitate trade and capture the money of who? The retail consumer. Okay. The stock market, the futures market, the options market works the exact same way. Does that make sense? Give me a Y in the chat box. All right, good. Now, let's talk about where you exit. Okay. Where you exit is going to be dependent upon your understanding of liquidity. Okay. So before we get into manipulation, before we get into entries, before we get into uh, managing positions, before we get into a trading plan, it is imperative that you understand liquidity. Okay. I want you to write this down. Liquidity is the retail trader's money. Okay. Liquidity is your targets. Liquidity serve as your targets. Liquidity serve as your inflection points in the market. Okay. We don't want to do anything until we see liquidity take it. Okay. We don't want to enter the market until we see liquidity taken. We don't want to exit the market until we see liquidity taken. Okay. Liquidity is the most important aspect of trading, period. You must understand liquidity through and through. Okay. Now, what do we define as liquidity? Okay. What do we define as liquidity? Liquidity is comes in the form of dojis. Liquidity comes in the form of double tops. Okay. Liquidity comes in the form of double bottoms. Okay. And liquidity comes in the form of imbalances. And liquidity also comes in the form of gaps in the market. Okay. Liquidity also comes in the form of gaps in the market. Okay. And it doesn't matter if you're looking at the weekly, your daily, your 4 hour, 1 hour, doesn't matter what time frame. This is where liquidity is. This is how we easily identify liquidity in the market in the form of a doji, double top, double bottom, an imbalance, or a gap. Okay. Now, this right here is an example of a doji. Okay. A doji is representative of what? Indecision in the market. Okay. And if you ask most retail traders, what is when they see a doji, right? What registers or what makes sense is a reversal, right? That there may be a potential reversal in the market, right? Because there's what some indecision in the market. Okay, because there's some indecision in the market. Okay, so doji serve as uh, an area of liquidity. This is an area of interest for us. Okay, now think about this: when you're looking at a chart and you're trying to find liquidity, okay, you have to think, um, and it's probably not hard for most of you. You have to think in the form of a retail trader. Okay, liquidity is present. Write this down. Liquidity is present when the market offers retail traders an opportunity to get into the market. Okay. Liquidity is present when the market offers retail traders an opportunity to get into the market. Okay. So if we take a look at the chart and we can see where a retail trader might have entered the market, we know that what there is some liquidity right above or below that candle or above or below that level. Okay. Now, you switch to another time frame. Just to give you all some clear examples, right? Here, let's take a look at the 5-minute chart. A double top, okay? A double top is when you have two candles, right? And they don't have to be right next to each other, okay? But when you have 2 points in the market, okay? When you have 2 points in the market that share the same price, okay? When you have 2 points in the market that share the same price, this is your double top, okay? Double tops serves as what, potential reversal or potential resistance areas for retail traders, okay? These are also high liquidity areas in the market. These are also areas in the market where retail traders are induced into trading, okay? And the opposite is true for a double bottom, okay? The opposite is true for a double bottom. That's an example of a double bottom. We have two candles that share the exact same tick in price. Okay. This is an example of your double bottom. This is also an area, right? That when you see this on the chart, no matter what time frame, this is a potential area that what retail traders have potentially entered the market. Okay. They have potentially entered the market. Now let's talk about imbalances. Okay. What is an imbalance? A imbalance is a candle, okay, that doesn't have a wick, okay, and it can be on the top or it could be on the bottom, okay. And what you want to make note of is you want to target imbalances on the 5-minute or higher time frame. It's not uncommon to see imbalances on your 1 minute or lower time frames, but if we see a imbalance on a 5-minute or higher time frame, okay, this serves as a valid liquidity area. Okay. Now, why is this? Why are imbalances liquidity areas? Okay. Let's take a look at this imbalance here. Okay. Those retail traders that sold here, okay, they didn't have any recourse. Okay. They sold at the high and the market just went straight down. Okay. The market didn't go against them one tick. Okay. The market didn't go against them in one, not even one tick. Okay. So this serves as a liquidity level because why? The institutions, the banks, the powers that be, they don't want to see what? Retail traders enter the market with no recourse. Okay. With no recourse. So I can easily look at a chart, find imbalances on the chart. Okay. And when I see a imbalanced candle, this lets me know that until it is taken out, that the traders who got in at that price point, okay, are currently winning. Okay, are currently winning. You don't typically see institutional or bank trades start a move with a imbalanced candle. Okay, imbalanced candles will soon be hunted, soon be solved, right? And we can see that as an example here, right? The imbalance here, right, was eventually solved there. Okay. The market tick one tick above that area to solve the imbalance. Okay. Now let's talk about gaps. Okay. Let's talk about gaps. All right. So let's take a look at this candle right here. Okay. This candle right here formed a gap in the market. Okay. This candle right here formed a gap in the market. Okay. How did it form a gap in the market? Because bar number 1 and bar number 3 do not share a tick in price. Okay. The low of bar number 3 and the high of bar number 1 do not share a tick in price. Okay. This is also a liquidity area. Okay. This is also a liquidity area. Okay. Now, does gaps make sense? Does that make sense? Everybody understand what a gap is when I explain a gap in the market? Okay. We got another gap here. Bar number 1, bar number 2, and bar number 3 right here. Okay. The low of bar number 1, right, and the high of bar number 3 do not share tick in price. So what? We have what? A gap in price. Okay. We have a gap in price. Okay. So these are our what? Liquidity. This is also a liquidity area. Now, get your notebooks out. Okay. There is a order to the strength of these liquidity areas. Okay. And the order is dojis are going to be our main source of liquidity. Double tops and double balances are going to run a close second to dojis. Imbalances are number 3, and gaps are number 4. Okay. Dojis, double bottoms, double tops, imbalances, and gaps. Okay. So this is the order of importance. Okay. Our doji being the most important, and our gap liquidity being the least important. So when you get to a point, I know some of you all have asked the question, you know, there's a gap here. Should I target it? There's an imbalance here. Should I target it? Right. We have to take all of these things into consideration to determine the strength of the liquidity. The doji liquidity is going to give us the most importance, double tops and double bottoms the second, imbalance is the third, and gaps the fourth. Okay. Does that make sense? Everybody we on the same page there. Okay, good. All right. So now everybody doesn't trade the same. Okay. Everybody doesn't trade the same. But the methodology, the style, the principles are universal. Whether you're a scalper or whether you are a intraday trader. Okay. Now, if you're a scalper, okay, these are traders who are looking for very small move, 2, 3, 4, 5 points in the market. Okay. If you are a scalper, your most important time frames are going to be the 1 minute to the 30 minute. Okay. So if you're a trader that likes to trade the ES and you're only looking to make 2, 3, 4 points every time you take a trade on average, okay, the 1 minute time frame to the 30-minute time frame is going to be your areas of relevant liquidity. Okay. You can mark out your liquidity on the 30-minute time frame, wind down to the 15, the 5, the 1, etc. Okay. If you are an intraday trader and you're looking for the bigger moves in the market, I'm an intraday trader. I like to look for the bigger moves in the market. I'm looking at the 1 hour to the daily time frames. Okay. Oftentimes in the trade room, in the Discord, we're looking and seeing different liquidity levels, and oftentimes it's due because of our difference in trading styles. If you're only looking to capture a few points at a time in the market, you're considered to be a scalper. Excuse me. And you need to focus on the 1 to 30-minute time frames. If I'm an intraday trader and you're looking for the larger moves in the market, we are going to be focusing on the 1 hour to the daily time frame. Okay. All right. So let's talk about this concept. I touched on it a little bit today or earlier in the trade room. It is the last area of liquidity. Okay. Understanding the last area of liquidity is going to keep you out of nonsense trades and low probability trading opportunities. Okay. So again, looking at gold here. Okay, looking at gold. On my daily time frame, okay, on my daily time frame, I'm going to start out by marking off my major areas of liquidity. Okay. I'm going to start off by marking out my major areas of liquidity. I got a doji up here that's unbroken. I have a doji down here that's unbroken. Doji right here that's unbroken. And I have this doji down here that's unbroken, which is also serves as a attempted FU. Okay. So these are my major areas of liquidity. Okay. Off on my larger time frame. Okay. I know that these I know that this area is unbroken because why? We got a doji here, right? And we made a move down. Has the market come back to trade above this level? Yes or no? No. Okay. The market continued down and it made another doji here, right? Has the market yet come back to trade above this level? No. Okay. The market continued down, right? And started to move up and it made it a doji here. Has the market come back and traded lower than this level here? No. Okay. Down here, right? The market moved to this level and moved higher. Has the market come back and traded below this doji here? No. Okay. So these are unbroken. These are unbroken levels. These what qualifies unbroken levels. These are what key liquidity targets in the market. Okay. Now, let's go to my 4-hour time frame. Doji liquidity here. This is where our double top came from. Doji liquidity here in the form of an attempted FU. Okay. So these are, excuse me, these are my 4-hour major areas of liquidity. Okay. These are my 4-hour major areas of liquidity. Everybody with me thus far? Okay. Now down to my 1 hour. One hour, I have doji liquidity here. Where I have doji liquidity here. And someone asked the question, what about the one before the last one? Why wouldn't this qualify as doji liquidity? Why wouldn't this qualify as doji liquidity? Because it's already been taken out. We already broke the high of that doji. Okay. We already broke the high of that doji. So we want to go through this process and look at only the dojis, the double tops, the double bottoms that have not been broken. Okay. That have not been broken. Now, let's talk about the last area of liquidity. Okay. Let's talk about the last area of liquidity. With the Catla X3, we also have what? Our liquidity markers. Okay. We got 21,000 and some change here. We have 17,000 and some change here between these two levels. And we have what? Major liquidity above the market in the form of our what? Double tops and dojis that we've marked out with these green lines. Right? Everybody with me thus far? Okay, good. Now, the last area of liquidity. Okay, on the 1 hour time frame. Okay, the 1 hour time frame, we have formed a FU to the upside. Okay, meaning that what? The market was going down. Okay, market was going down. The next candle opened up, right? And it went lower, taking out the liquidity below. And then it ultimately did what? Reverse to finish as an up bar. Okay, it reversed to finish higher. This is what a prime example of a FU to the upside. Okay, now, do I have liquidity to target above the market? Absolutely, I do. Okay, absolutely, I do. But do I just jump in? Okay, do I just jump in because I got an FU to the upside and I have liquidity to target, major liquidity to target above the market? Absolutely not. Right. But the $1,000,000 question is, where should I enter? Okay. Or what is the most relevant area, or what I call the last area of liquidity? Okay. Now, how do I find the last area of liquidity? Okay. I think, okay, I have a bias that the market is going to go up right after this FU to the upside. Okay. I have a bias that the market is going to go up because of this FU to the upside. So in order for me to calculate liquidity or find the last area of liquidity, right? I need to evaluate, okay, this move. Okay. I need to evaluate this move. Now, how do I evaluate the move? Okay. I'm looking at each one of the candles, right? And seeing if the market has generated liquidity. Okay. And has it generated unbroken liquidity? Okay. Has the market generated unbroken liquidity? Yes or no? Yes. Okay. Yes, the market has generated unbroken liquidity. Okay. How has the market generated unbroken liquidity? Well, for one, we have this doji liquidity here that resides on what, our major liquidity level. We also have what, doji liquidity here. Okay. We also have doji liquidity here. Okay. So if my expectations are for the market to do what, move higher, and in this instance, I'm expecting the market to move higher because why? We generated liquidity here. We got liquidity above the market. Okay. And we also generated liquidity in the form of an imbalance. Okay. But before I can target, okay, before I can target this area, I have to understand where is the last area of liquidity. And the last area of liquidity, right, is right below this doji. Okay. So my expectations, right? My expectations, according to my trade plan, I wouldn't enter a long trade until what? The market breaks and takes out this last area of liquidity, right? And then give me a rejection or a move higher. Okay. Most people, and this keeps you from dealing with FOMO. Man, I know the market is going higher, and you just jump into a long trade. Okay. Understanding the last area of liquidity prevents you from having FOMO. Okay. Sometimes, guess what? The market is going to take off and not get this last area of liquidity. Okay. Guess what? These are trades that we do not take. Okay. These are trades that we do not take because what we know about the banks and the institutions are what? If the true move is indeed higher, okay, they are going to come back and take out this last area of liquidity and then take the market much higher. Okay. We know the banks and the institutions aren't going to leave this trail of liquidity behind before it makes the true move to the upside. Does that make sense? Everybody with me? Give me a Y in the chat box. Okay. So let's go through another let's go through another example. All right, so let's take a look at let's take a look at, we had a move higher, then all of a sudden we had a strong FU to the downside. And we know it's a strong FU to the downside because we have a blue triangle. Okay. We got a blue triangle that indicates what, a strong FU to the downside. Green triangles indicate a strong FU to the upside. Okay. So the market comes in, takes out, let's just say this was a point of interest, right? So we get to the market, we've already formed a FU to the downside, and the next candle starts to move lower. Okay. You expect the market to do what? Move lower, but then it does what? Move higher and forms a doji. Okay. It forms a doji. Now, this doji has left behind what? Liquidity, right? And then it came and formed another doji here to form a double top. Okay. Now, do we just hop in the short because we get a short signal? Absolutely not. We wait for what? This liquidity area to be taken out. The market forms another FU to the downside. Okay. And then you see the market gets its true move. Okay. Then you see the market gets its true move. So identifying your last area of liquidity. Where did the market generate liquidity? Okay, because we know if it's truly a bank or institutional move, that what the market has to come back and take out this level. Okay. And we got the question, when that area of liquidity is taken out, do we open our position? No, we don't just automatically open our position. Okay. We don't open our position until what? We get further manipulation to the downside. Okay. Not until we get further manipulation to the downside. Liquidity was taken out here on this candle right here. Okay. But we didn't get further manipulation to the downside until this candle. Okay. So this candle would serve as our what? Entry opportunity. We already had the bias that the market was going to go short. Okay. It retraced a little bit, generated liquidity. We waited until liquidity is taken out, in our entry opportunity, right, is when we get manipulation in our intended direction. Okay. And even when price came back here over the course of these 2 hours, you see we never broke back above this move. This was a testament to that this was a true institutional move in the market. Okay. Now, why is this important? Okay. Why is this important and why does it work this way? Okay. Think about this. Okay. Now, is a FU, is it a low liquidity move or a high liquidity move? It's a low liquidity move. Okay, write this down. Low liquidity moves equal institutional moves. High liquidity moves equal retail moves. Okay. Now, when it's a low liquidity move, guess what? There is still some liquidity left behind. Okay. So when we see a FU, when we get into entries, this is why we don't enter until we get some type of retest, at least of that area. Okay, until we get some type of retest of that area. Now, when the market generated liquidity here, okay, the market simply did what? Came back and got any little bit of liquidity that was left over in this wick, or any liquidity that was left over from generating the dojis and the double tops. Okay. So when we get another single point of manipulation, okay, we can assume, okay, that any liquidity that was left behind, the market was able to capture it. Okay. When we enter the market, okay, and I want you to write this down. When we enter the market, we always want to enter on some type of retest. Okay. We always want to enter on some type of retest of manipulation. Okay. We want to always enter on some type of retest of manipulation, because guess what? The retest is the last grab of the liquidity crumbs that are left behind from the initial manipulation. Okay. When the market comes back and retests an area of prior manipulation, okay, we can view this as the market grabbing the last bit of liquidity crumbs before making its true move. Okay. This does not give what? The retail trader an opportunity to enter the market. Okay. The difference between a high liquidity move and a low liquidity move is simple. Okay. A low liquidity move is one that is inclusive of manipulation. Okay. A low liquidity move is one that is inclusive of manipulation. Okay. A high liquidity move, right, is a move that isn't inclusive of manipulation. Okay. Meaning that what? We don't see any FUs, um we don't see any order blocks, we don't see any volatility candles. Okay. These are moves that are high liquidity moves. These are retail trading moves in the market. Okay. Low liquidity moves are moves that are inclusive of manipulation. FUs, the retest of a FU, high confirmations, setups, etc. All right, we all on the same page? Give me one in the chat box. All right, good. So this next concept, okay, the next concept, calculating liquidity. Okay, calculating liquidity. Okay, the market, it is impossible. Okay, it is impossible for the market to grab all of the liquidity all of the time in a move. Okay. It's impossible for the market to grab all of the liquidity and all of the time in a move. Okay. So let's take a look at this 15-minute chart right here. And let's pay specific attention to the market up to this point here. Okay. Write this down, pay attention. When should you forget about liquidity that is left behind? This is what I call the concept of calculating liquidity. Okay. We understand our last area of liquidity. Where is my last area of liquidity in this 15-minute move here? Here and here. And I got a double bottom here. Does everybody see that? Right? Market generated liquidity here. Okay. I would include this as a doji, as a point of indecision, right? And a clear double bottom here. Okay. These are these are clear 15-minute liquidity areas that we would typically target, or that would come to our attention in the market. Okay. Now, how do I know when the market is okay with leaving this liquidity behind only for it to be hunted later? Okay. This candle here. Okay. What is this? This is a FU to the upside. It's a strong FU to the upside. Why? We know it's a strong FU to the upside because of what? The green triangle. Okay. If the market has generated liquidity on a move, right? And then we get manipulation in this same direction, it is telling me that what? It is okay with leaving this liquidity behind for now to be hunted at a later time. Okay. It is letting me know that what? The market is still in search of what? Liquidity, in this instance, higher. So the liquidity that we left behind here, okay, we don't need to try to what? Continue to short the market. Okay. Once we got this manipulation to the upside, it is letting me know that, hey, the liquidity that we left behind, okay, we're okay with leaving it behind only for it to do what? To be hunted at a later time. Okay. So our focus immediately shifts into what? Understanding where is liquidity above the market. Okay. And Tony, even in this instance, right? This FU got broken, but it was broken and also formed a what? An attempted FU to the upside. and then it came back and formed what? Another FU to the upside here. Okay. So no, this I'm giving you all examples in a 15-minute time frame, but the concepts aren't time frame specific. For example, right? Those in the trading room today, we was looking at the S&P 500. Let's take a look at the ES. And let's take a look at our 5-minute time frame. Right? So we were in a trade room around this time, and the market did what? It left us. We got into the long trade, right? We got into a long trade. The market gave us doji liquidity here. The market also gave us what? A 5-minute imbalance, and we know that, hey, when we see an imbalance on a 5-minute time frame, that we need to pay attention to what's going on, right? And then we got a FU to the downside, a strong FU to the downside here. Okay. After what? Attempted FU to the downside here. Okay. I actually took this short initially, and I got stopped out of the trade. Okay. I got stopped out of the trade because I had a what? FU to the downside and another FU to the downside. And I was looking to do what? Target this imbalance here. Okay. But what immediately happened? Okay, what happened after I entered the market, right? So understand what determines the outcome of your trade? Everything that happens after you've entered the market. Okay, after you've entered the market. This what determines the outcome of your trade. Immediately after I took this short and got stopped out, the market formed a what? After I got into the trade, the market came back and formed a what? 5-minute FU to the upside. Okay. 5-minute FU to the upside. At this point, there was no need for me to do what? Come and look for shorting opportunities. It was letting me know that this imbalance that I was initially targeting on my short, right? And ultimately this 5-minute doji liquidity, that the market was okay with leaving this liquidity behind for now, right? And it was still in search of liquidity above the market. Okay. And we came back with what? Another 5-minute FU to the upside. Okay. Manipulation to the upside here, manipulation to the upside here. So any liquidity on the 5-minute time frame, okay, that was left behind, the market was telling us that it was okay with leaving that liquidity behind only to be hunted at a later time. Does that make sense? All right, perfect. All right, so now let's move to part number two. Where do you enter? Okay, where do you enter? I want everybody to write this down in big, bold letters. Okay, everybody, I know everybody is obsessed with the entry. Okay, but the entry is actually um, not the most important part of trading. Okay, okay. Where do we enter? We only enter at areas of previous manipulation or a retest of manipulation. Okay. So every entry point in the market must consist of some manipulation. Okay. Every entry point must consist of some manipulation. Okay. If we're looking, let's take a look at the 5-minute time frame. Okay. These dashed lines on our Catla X3, okay, this entire area is an area of manipulation. This entire area is an area of manipulation. Okay. We only want to take trades from areas of manipulation. Okay. Why do we only want to take take trades from areas of manipulation? Because we know that this is where what institutions and the banks have participated. Okay. If we want to take the best possible trade with the best possible risk to reward opportunity, we need to take trades that are on the same side of the banks and the institutions. Okay. We want to take trades on the same side of the banks and institutions. So we want to enter the market where what banks have participated. Okay. We want to enter where banks have participated. Now, the Catla X gives us what? Institutional participation in real time as it's developed, right? And it shows us where participation has happened previously. Okay, but these also form in real time and gives us what? The real time buy and sell signals in the market. Okay, we only want to take trades from areas of previous manipulation or what as manipulation is occurring in real time. Okay, does that make sense? All right, so we already have our Catla X3 zones. Okay. The Catla X3 is not just for signals. These are zones of manipulation. These are zones of institutional and bank participation. Okay. The other areas of concentrated manipulation. Go to another market. The other areas of concentrated manipulation are what? Our order blocks plus FUs. Okay. Order blocks plus FUs. Okay. So for example, I'm looking at what am I looking at? I'm looking at the USD JPY, right? On the 4-hour time frame. Let's take a look at this up move right here. Okay. This up move here. Okay. We have what? Our last green candle here. Okay. In this same zone, we have what? Manipulation to the downside. Okay. So if I was trading the USD JPY, I have my Catla X zones, and I also have my order block that has a FU inside of it. Okay. If I can find, okay, if I can find a area that has a order block plus some type of FU manipulation, okay, I mark out the body of the order block. Okay. I mark out the body of the order block. Okay. Here, our last red candle followed by what? A FU to the upside. Okay. So what do I do here? I take the body of the candle. I stretch it across the screen. Okay. It's a order block. Okay, it's an order block because this is the last green candle in this up move. Okay, followed by what? Manipulation to the downside in this zone. This is the last red candle, right? In this down move, followed by what? Manipulation to the upside. Okay. These are what we consider to be what our high concentrated areas of manipulation. Okay. These are our highly concentrated areas of manipulation. I only want to take trades from where these highly concentrated areas of manipulation. Same thing here, right? Last red candle followed by what? A FU to the upside. Okay. Chevelle asked for that order block to the downside. Why not use the green doji body? Because this is these are actually this candle right here is actually a down candle. Okay. This candle right here is actually a down candle. I want the last point. I want the last point that what the market was buying before what we got manipulation to the downside. Okay. This is where what the buyers ran out of steam. This is where the institutions came in and did what? Grab liquidity and reversed in the opposite direction. Okay. This is where what the sellers ran out of steam. The market went a little lower and then it did what? Reverse directions higher. Okay. The market, the sellers ran out of steam here. Market went lower and reversed higher. Okay. These are my highly concentrated areas of manipulation. Okay. So the only place, okay, again, I told you we're going to keep it simple, right? The only place that I want to take a trade from, okay, 95% of the time, the other 5% of the time, and we'll go through the caveats over the next month inside of the trading room, but 95% of the time and 100% of the time when it comes to developing my trading plan is I only want to take trades from order block plus FU zones or what? Highly concentrated areas of manipulation that's outlined by what? My Catla X zone. Okay. Does that make sense? Yes, institutional zones can be the last area of manipulation. Okay. Now, again, I'm switching back and forth between futures, and this is the USD, this is the JPY. So let's take a look at the 5-minute time frame and how these things lined up on our execution time frames. All right, so if I'm looking at my 5 minute time, my 5 minute time frame or my execution time frame, right? I got this zone, right, that begin way over here, right? And we got what rejection here in a move down. We got a rejection inside of here to a move down, right? This zone started here, went down roughly to that zone back here, retested this zone, and the market did what? Continue to move higher. So you see, it doesn't matter if you're trading US forex, futures, options, etc. Manipulation is present. Manipulation is key, and understanding where the institutions are participating is key, right? Look at the Catla X3 zone here, right? Market came here, retested this area of manipulation. We start manipulating again, and forming an additional Catla X3 zone. So I only want to take trades from where my Catla X3 zones or what highly concentrated areas of manipulation from my higher time frames. Okay. And again, keep in mind, we're listen, if you're a scalper looking for small movements in the market, go back to what I said at the beginning of the webinar. You go through this exact same process, but what you only need to look at the 1 to the 30-minute time frame. If you're looking for longer moves or larger moves, then you can do what? Look at the 1 hour to the daily. I like to trade intraday, right? So I lean on the 1 hour, 4 hour in the daily time frames. If I'm looking for a smaller move in the market, or if I want to scalp, okay, I only need to apply these same concepts up to the 30-minute time frame. Does that make sense? All right. So now um let's talk about manipulation strength. Okay. So when we're going to we're looking for entry opportunities. When we're looking for entry opportunities or the retest of manipulation, okay, we need to know what forms of manipulation hold the most weight. Okay. What forms of manipulation hold most weight? Okay. And again, in this order, okay, from the least weight to the most weight. Okay. It's your attempted FU. That's your weakest form of manipulation. A single FU, okay, which you see on the charts with your green triangles and your blue triangles. Green triangles are FUs to the upside. Blue triangles are strong FUs to the downside. Okay. So attempted FUs are your weakest. FUs are next. A FU retest and a high confirmation setup is your strongest form of manipulation. Okay. So when you're doing your top down analysis, okay, when you're doing your top down analysis and you're trying to see, oh, well, I identify, let's take a matter of fact, I got a good market for it. I'm trying to identify whether or not it is a strong move or not. Okay. We know that what attempted FUs are your weakest. A single FU is next. A FU retest, and then a high confirmation setup. Okay. And we also know that the larger the time frame, the more powerful the manipulation is. Okay. So a 4 hour manipulation is going to be stronger than a 1 hour manipulation. 1 hour manipulation is going to be stronger than a 30-minute. 15 minutes is going to be stronger than a 5, etc. Okay. Now, last week, right? Let's take a look at the S&P on a daily time frame. Okay. We had a strong FU to the downside form. Okay. And we came back with what? Another strong FU to the downside the following day. Okay. This was what? An attempted FU, and it was followed by what? A strong FU. This is a strong move. Why? Because it happened on a daily time frame, right? And we had a FU followed by what? Another FU in the same direction. Okay. So that's why what was it? Thursday, right? We had a massive day in the market on Thursday. We had another great day in the market on Friday for those who traded. And we were confident that what we can continue to be short in the market because our daily time frame gave us what? A high confirmation setup to the downside. Okay. Now let's look at a move. All right, so let's take a look at this. Let's take a look at this move right here, right? What type of manipulation is this right here? What type of manipulation? Yep, good. It's an attempted FU. Okay. And it's an attempted FU because why? The FU did not break what? The body of the previous candle. Yes, we grabbed liquidity above this candle and we reverse to do what? Finish lower. Okay. But this is what? Our classic example of what? An attempted FU. Okay. Now, based on what I gave you, okay, not saying that attempted FUs don't hold, but just understand that this is the weakest form of manipulation. Okay, this is the weakest form of manipulation. So if I'm doing my top-down analysis and I'm going back and I'm marking my FU zones or my FU areas, not only am I marking these areas, but I'm also paying attention to what? How strong are these areas in the market? Right. So if I was to stretch this out expecting a retest, okay, in the market, I know that what? This is the weakest form of manipulation. So if I'm entering a trade, right, or if I'm looking to take a trade to the downside, I may only take this trade with what? A half a position or a quarter of position, knowing that what? This is the weakest form of manipulation. Now, this when it came back and retested this area, okay? When it came back and retested this area, what happened? Yeah, it rejected it, but it also formed another what? It also formed another what? FU. Okay, it also formed another FU. And guess what? When you see the word short on your chart, okay, this equals, write this down, this equals a high confirmation setup. Okay, so manipulation that was initially weak, okay, end up turning into what? Our strongest form of manipulation. Okay. Why? Because it was a what? High confirmation setup. Okay. Meaning that we had a FU to the downside. And when the market came and retested the FU to the downside, it made another FU to the downside. Okay. This is what we call our high confirmation setup, and this is our strongest form of manipulation, and this is a sure sign of banking institutional participation. Okay. And as we can see, what happened? The market did what? Came and did what? Retraced and made our move down here to this area of manipulation here. Okay. Now, the difference between a high confirmation setup and a FU to the downside, let me show you an example. I'm in a FU retest. Danae, we want to go as far back, okay, until we have relevant zones that aren't broken. Okay, relevant zones that aren't broken. Here we can take a look at this one right here. It's 30 minutes. Okay. Now, blue triangle. What does a blue triangle represent? Strong FU. Okay. So a FU retest would be simply the market coming back to test the edge up to the 50% level of the wick. Okay. And it doesn't form another FU. Okay. So this bar tested it. Okay. And this candle tested it here as well. And neither one of these formed a FU. So this would classify as a FU retest. Okay. We had a test here and this area tested here as well. Okay. And neither one of these formed a what? FU. So again, we have what? Attempted FU, FU retest. I mean, attempted FU retest in what? High confirmation setup. Okay. Everybody on the same page. Yes, the high confirmation setup is what? A FU being retested and it forms another FU. This is our high confirmation setup. Okay. And this is what? Our strongest area of manipulation. So, for example, right, let's dive a little bit into what? How we should be refining our entry zones inside of the Catla X. And this is a perfect example. Okay. Let's just say let's just say we came to the market, okay? Our Catalyst X gave us a sell signal, okay? Our Catalyst X gave us a sell signal, but we didn't get to the market until we didn't get to the market until, let's just say, 6 o'clock, right? We didn't get to the market until this candle here. Okay. We know that what the Catalyst X zone is what? A highly concentrated area of manipulation. Okay. Now, what do you do? How do you use it to its max efficiency? Yes, you can just take the sell signals. You can just take the sell signals at the break of the zones, the buy signals at the break of the upper zones, right? But let's go back to what we talked about earlier. Okay. The Catalyst X gave us a sell signal on this bar right here. Okay. We didn't arrive to the market until this bar right here. Okay. Now let's think about this. We now have to do what? Assess the market from what? The beginning of our Catalyst X manipulation zone to the point in which we entered the market. Is everybody with me thus far? Okay, good. Now, in this move from the beginning of the zone until the point we arrived at the market, did the market generate any liquidity? Yes. Okay. In the form of a doji, right? In the form of a doji. Okay. In the form of a doji. Let me clear that out and make this clear for you. Form of a doji, we generated liquidity there that hasn't been broken. Form of a doji with liquidity there that hasn't been broken, and we arrived here at the market at 6 o'clock. Okay, these are what our last areas of liquidity. Okay, now that I found my last areas of liquidity inside of my Catalyst X3 zones, okay, I now need to assess, okay, how strong is the manipulation that formed the zone? Okay. How strong is the manipulation that formed the zone? Now we have 4 levels of strength. What's our first level of strength? Attempted FU. Is this an attempted FU? Nope. Okay. Is this a strong FU? Yes. Okay. Has this FU been retested? Yeah, not quite yet. Okay, not quite yet. So we know, okay, that what? I'm looking at a level 2 strength of manipulation in this zone. Okay. I'm looking at a level 2 strength of manipulation in this zone because I have what? A strong FU, right? And I have what? Liquidity that has been generated that has been unbroken. Okay. So instead of just, how do I figure out the 50% point of the candle? Half of the wick. Okay. Half of the wick. Split it in half. That's 50%. Okay. So my retest zone, or your retest zone, would be where? From the top of the body to half of the wick. Okay. Top of the body to half of the wick. Okay. So instead of me getting FOMO, okay, I understand that we got liquidity left behind there, and we got liquidity left behind there. Okay, so and I'm only looking at what a level 2 strength of manipulation. Okay, a level 2 strength of manipulation. Okay, so what am I looking for is what I need this liquidity taken out before I could think about it entering. I need this liquidity taken out before I'm thinking about an entry. Okay, and what do we get here? We get a retest, right? Which now turns this into a what? A level 3 strength of liquidity. Okay. And then we get our move down. Okay. It's not a 4 because a 4 is our high confirmation setup. A FU to the downside, retested, and the retest forms another FU to the downside. Okay. Does that make sense? Okay. Before we just jump in trades, right, to say oh well, Catlex gave me a buy signal, Catlex gave me a sell signal. This is how you use it to your max efficiency, right? I need to understand, right? Did we generate liquidity? Okay. Did we generate liquidity? Okay. So even when the market broke down here, 9 times out of 10, I probably still wouldn't enter on what this sell signal because what I still had doji liquidity up here, which was my last area of liquidity. And if it is a true institutional move, okay, I know that the institutions and the banks have to come out and take out this last area of liquidity before we can make the true move to the downside. Okay. And again, we can see this on every time frame. All right, look, our execution time frame, right? Execution time frame. And out of here, let's say we looking to the market breaks higher, right? Out of what our previously manipulated Catla X zone, right? Market breaks higher. Now, if I go back and I look at my last area of liquidity, I have what? I got Doji liquidity right here. I had Doji liquidity right here that needed to be broken. Okay. So if I was looking for a larger move to the upside, okay, because we broke out higher, so we like, okay, this is a manipulation, highly concentrated area of manipulation. We broke higher, the market is going to make its move higher. Okay. We are not to take the trade until what? We get what our areas of last areas of liquidity taken out. Okay. So whatever time frame that you're looking on when you're looking at the Cala X3 signals, okay, I want you to start taking a dive into what? Into the box, into the zone, see what's going on, calculate liquidity. The same move that we're looking at right here on the 15-minute time frame. Move into a previously manipulated zone, and we get what? A high confirmation setup. Okay. The market moves back into the zone on a 15-minute time frame, and we get what? Another high confirmation setup, and the market does what? Makes its true move higher. Okay. When we get high confirmation setups, okay, high confirmation setups are our strongest point of manipulation because high confirmation setups have the least amount of liquidity. Okay. It is the lowest liquidity move. A high confirmation setup is the lowest liquidity move. Everybody with me thus far? Okay. So before we dive into, oh, the market is going higher, right? The market has to do what? Give us confirmation that we're going to continue to go higher. Okay. We just don't get in alone just because the market is moving higher and we feel like, oh, we missed the area. No, we need to understand where is our last area of liquidity. Okay. Understanding where our last area of liquidity, along with calculating liquidity, letting us know when is the market saying, okay, okay, it's okay to leave this liquidity behind only to be what? Hunted later. Okay. Makes sense? All right. Last thing that I'm going to cover today, before I open it up for a few questions, are our volatility candles. Okay. Our volatility candles, which are our purple candles that you see in the Catla X3, okay, are clear shifts in supply and demand. Okay. Clear shifts in supply and demand. Okay. How do we know that they are clear shifts in supply and demand? These purple candles, okay, if you see a purple candle, it means that it is simply larger than the three previous candles. Purple candle is larger than its three previous candles. Okay. Now, when we start talking about momentum, right, or the move or the speed of a market or the continuation or the contraction of the market, right, or being able to assess or calculate the volatility when we're looking at the liquidity, all of these things are important. When you think about a clear shift in supply and demand, again, we have to think that the institutions or the banks are involved, right? Because who has enough buying or selling power, right, to shift the supply and demand in the moment of the market? Who has that type of power? Right, the banks and the institutions. Okay. Now, why are the volatility candles important to me? Okay. They're important to me because for one, they show clear shifts in supply and demands, letting me know that what there's some type of institutional, or it's a high probability that there's some type of institutional or banks at play here. Okay. The second use is to let me know, right, if the market is in a place of continuation or if it is in a place of contraction. Okay. Are we shifting supply and demand to contract, or are we shifting supply and demand to expand? Okay. We made a shift in volatility. Is this a contraction or is this a excuse me, or is this a continuation of volatility? Okay. So what do I look at is after, let me clear this out. After I get a purple candle, okay, I'm always paying attention to how the next three bars close. Okay. I'm always paying attention to how the next three bars close. Okay. So for example, we got a volatility candle to the downside, and the next three candles closed above the close of what? The volatility candle. Okay. What this tells me is that it's a high probability, okay, that the market is going to do what? Come back and at least close the gap that it left behind. Okay. I use this when I made my first seven figures in the market. I was trading the bonds, and I use gaps in my understanding of contracting or continuing volatility to execute my trades. Okay. I will look for clear shifts of supply and demand. And if the next three candles close above the close in a down move, right, I knew that there was a high probability that we were going to close the gap that was formed between what? Candle number one and candle number three. Okay. And if you go back, you can see this happen time and time again, right? This was a volatility candle to the upside. The next three, we didn't get three candles that closed above the close of it, right? And what? The market came back and filled the gap between candle number one and candle number three, right? And I would literally scalp this all day long. Okay. Now, a sign of continuation. Okay. I got a volatility candle here, right? And my next three candles, excuse me, right? Essentially close below the close. I knew that what? This was a continuation to the downside. Okay. So when when I'm in a trade, when I'm in a trade, when I get a volatility candle, because again, this is one of the things that's going to help you get out of missing out, or just hoping, wishing, and praying that you know what the market is going to do. Because why? Everything that affects the outcome of your trade, what is dependent on what happens after you've entered the trade. You have no control over. So when I'm actively managing the trade, and I'm gonna dive deeper into this a little more tomorrow, is when I get a volatility candle. Let's just say I'm going short in the market. Okay. Let's just say I short it from here. Okay. The next candle was a volatility candle. My stop would go behind the volatility candle. Okay. I get another volatility candle, right? I'm effectively at the very minimum moving my stop behind what? Volatility candle to volatility candle. Okay. So I use the volatility candle to show me clear shifts in supply and demand in real time, right? And I also use it to help determine if volatility is contracting or if it's continuing or expanding in the market. Okay. And yes, if I don't have it, Nate asks, am I staying just one tick behind at that point? Yes, if I don't have another spot to move my stop, I move my stop behind the volatility candle. Okay. And let's just continue with this trade, Nate. Um, so my stop is here, and then I get what? I get an attempted FU manipulation to the downside here. So now my stop would be effectively move one tick behind that attempted FU. Okay. All right, it's nine. It's 9:09. I'm gonna open up the floor for a couple of questions. I only want you to ask me questions about things that I went over tonight. Okay. Tomorrow we're going to talk about the win. Um we talked about where we should enter. We talked about where we should exit. We talked about liquidity. Okay. Tomorrow we're gonna talk about the win, right? The confirmations, because all of this is going to tie into our trading plan, okay, and putting our trading plan together. So what we went over tonight is the foundation. So I am going to open up the floor for a few questions. If you want to ask a question, I'm going to ask you to come on the mic. I'm not going to read through the chat box for the questions. I want you to turn on your mic. So if you want to ask a question, raise your hand. I'll turn on your mic and we'll go from there. All right. Yep, it's all about the process. All right, Danae, you got the mic.
Hello, how are you? I have a quick question about the volatility candles.
Okay.
I was trying to figure out on what time frames should I be looking at it, and I was kind of confused on the entries of it. I know you said look at the three after the purple candles. We're looking at the three candles that come after it, but where do you enter? I was kind of confused on that. I got the risks where you will put your stops at, but where am I actually entering?
Okay, so you were talking about when I was talking about my scalping strategy for the bonds.
Yeah, because I like to scalp, so this sounds very interesting to me.
Okay, cool. So what I would do is simply this, right? Let me just move this out of the way for a second. So what I would do is after I got a volatility candle, I literally would box in the next three candles.
Mhm.
Okay. Right. And after I boxed in the next, and my gap is where my gap is here. Okay. So my entry would be a break above the box of those three candles. So my entry would be here, right? And my exit would be the close of the gap or the close of that liquidity gap.
Got it. Okay. Would you do this on what time frames are you doing this on? A 1, 2 minute or
Yeah, so on the bonds, I would use either the 1 minute, 3 minute, or 5 minutes for the ZB.
and then you're so when we're going up on this trade that you just did, the stop would the stop be under the doji? Like say if
No,
it
my stop would be under the candle that broke the box.
got it. Okay.
That answer your question?
Yes, thank you so much.
Yeah, no problem. I appreciate you. All right, who next? Hit your raise your hand. I'll bring you the mic. Chevelle, you had a mic.
Hello, good night. Um, so the FUs, I know you said it's like if the market like was going down, then the next candle went lower and then ultimately reversed to finish higher. That's a FU.
So
That's I understand.
so like let me show you examples of strong FUs, right? Because it's easy to see with the triangles, right? So this is the second level of strength. Okay. You see how the market was going higher, right?
Yeah.
Okay. And then that you see the green candle, the higher the green candle, the very next candle, right? It went
Mhm.
above the green candle, but then it reversed and finished lower than the body of the green candle.
Mm, mm,
Okay. And the opposite is true here. Okay. This candle was going down, right? The market opened up and it went even lower, and then it reversed and finished higher. Okay.
mm.
So that's a FU to the upside.
Okay.
Okay. So you always looking at the previous candle. Okay. Looking for the market to do what? Initially go in the same direction as the previous candle, higher in the event of a FU to the downside, only to do what? Reverse lower.
So if the body closes below the previous body, that's strong.
That's a strong FU. Okay. If we get this same type of action, like right here, okay, this is a attempted FU because this candle didn't close above the body of the previous candle. Okay. But it did do what? Go lower
And then reversed.
and it reversed higher. Okay. So that's your attempted FU. That's your weakest form of manipulation.
Okay. Um, okay.
Okay. That answer your question?
Yeah, it
All right.
does.
All right, cool. Thank you.
Mm.
AP, you got the mic.
All right, man. Appreciate you. First off, I just wanted to know what the numbers mean inside of the liquidity boxes and
So
how important.
okay, good question. So the numbers inside of the liquidity box lets you know exactly how many retail traders or retail contracts or how much liquidity is there, right? So right here we got 106,000. Right here we got 22,000. Right? We had 13,000 there. Okay. So for example, let's just say we got 106,000. We got 106,000 right here, right? And let's just say up here we had 200,000. We had 200K. And let's just pretend that the market was in the middle of the range right here. Okay. Now we know that the market is always hunting liquidity. Now, if you had to choose, right? If we wanted to develop a bias, of course, considering all other manipulations and last areas of liquidity, right? Would you go after the 200K or would you go after the 106,000?
200.
The 200K. Okay. So all other things aligning, okay, we know that the market is always going to be attracted to where the most liquidity resides in the market.
Okay. So just extra influence, basically, with more detail.
Yes, exactly.
I appreciate it.
Yep. Yusuf, you got the mic.
Hey, General, what's up?
Not much, man. How you?
I'm blessed, thank you.
Good.
I just wanted to know, like, I have an idea, but I want to know how you think about deciding on the trend or bias. I'm talking about a higher time frame. Like, do you look at the trend on, let's say it's going down, or you just look at the last strong FU? Like, for example, if there's a reversal, then you're gonna say, oh, forget the rest that is trending down. I'm just gonna look at the last FU going up, and that's how I'm gonna base my next trades.
Yeah. So good question. Right.
Thank
So I am always looking at, let me go to another market. Go to John's favorite market.
It's mine too, thanks to him.
All right, so let's look at we're looking at the NQ on the 4-hour, right? I could care less that we've retraced higher, right? Why? Because what direction is the most recent level of manipulation?
You have an attempt to the upside right there.
Huh?
Oh, you have a, isn't that an attempted? I don't see the colors very well. The second to last purple, is that going up?
What, this one right here?
The one beside it on the left? Isn't that attempted to the upside?
No,
Attempted FU?
no, that wouldn't be, that's not what we consider the attempted FU, because this is a red candle.
Yeah, sorry, I don't see colors very
Yeah.
well, man.
No, it's all good. So the most recent direction of manipulation is what?
So that's an attempted downside, right?
Yep, that's an attempted downside, but it's also what? Attempted plus a retest,
Yeah,
right? So this is a pretty strong level of manipulation here.
perfect.
Okay.
Let's say before that attempted FU, if the market was going up and then you saw that attempted FU to the downside, you would forget everything before that and say, on the 4 hour, the last thing I had was an attempted down, so I would base my bias going downwards.
Going downward. Now,
Perfect.
what would change my mind, right? And everybody take notes of this, and this is a good question. The only thing that would change my bias, my general bias, and this isn't to say that I couldn't find a long trading opportunity here on a different time frame, okay? But looking at this 4 hour time frame, the only thing that will offset a 4 hour FU is a 4 hour FU to the upside.
Attempted or strong, it doesn't matter, right?
Yeah, attempted or strong, it doesn't matter. Okay. So now let's dive a little deeper into it, right? the current the current price action, where would the market have to go in order to start forming an FU to the upside? Where is the market in the right, where's the right place for the market to possibly form a FU to the upside? Right? The market would have to do what?
Oh
Trade,
yes, grab. Yeah.
grab liquidity below
Yeah.
here, and then reverse higher. Okay. So if I'm looking for this FU here to be negated on my 4 hour time frame, if that's where I'm getting my bias from, I need a FU to the upside to form. Okay. And the market has to form that FU to the upside in the right place. Where's the right place for it to form? Okay. It has to do what? Go below the previous candle and then reverse back higher.
Gotcha.
Okay. Makes sense, everybody? So when you're looking at reversal trades or opportunities to reverse or go in the opposite direction, you have to make sure that the market is in the right place to reverse. It has to be in the right place to form a FU in the opposite direction. Until then, what we still lean on our what? Our bias, right? All right, Jonathan, you got the mic.
Hey everyone, how y'all doing today?
Good. How you?
Doing good, doing good. I just wanted to ask a quick question about the confluences of liquidity on different time frames.
Okay.
I just wanted you to just speak a little bit about it.
So again, right? The first thing is to decide, okay, am I going to scalp, okay, or am I going to am I looking to day trade, intraday, right? So
Right.
if I'm scalping, I'm after the liquidity that is present on my 30-minute time frame. Okay, that's what's important to me. Okay,
Gotcha.
if I'm a scalper, if I'm looking for an intraday or a bigger move, then I'm looking for where's the relevant liquidity on my 1 hour, 4 hour, or daily time frame.
Okay, yeah, because I'll be doing knockouts and I'll be trying to. I really the last area of liquidity today helped me out a lot because I get stopped out a lot of times and then it ends up going in my direction. And I think
Yes,
that last area of liquidity helped a lot today.
yeah. So finding that last area of liquidity and taking a knockout with what, a stop below that last area of liquidity is going to be key.
Gotcha. Appreciate it, man.
Yeah, appreciate you.
Yeah.
Stan, you got the mic.
How you doing?
Good. How you?
All right, sir. Thank you for what you're doing.
Yeah, appreciate it.
Yes, sir. I got a question. I'm trying to wrap my mind around the difference between low liquidity moves and high liquidity moves. You said that we want to focus more on the low liquidity moves and not the high liquidity moves because the high liquidity moves is not inclusive of manipulation. But I'm trying to understand, does this mean that there won't be any manipulation in the retail move?
No, so if there is manipulation present in the move, then it is what? It's a low liquidity.
Low
We can say
liquidity.
it's a low liquidity move. Okay. And it's not that, and it's not that we focus more on, it's not that we focus more on low liquidity moves or high liquidity moves, right?
Okay.
What we do is we understand the move that is being made. Okay. So if the institutions are let's just say the institutions push gold up to and it's a 4 hour time frame, right? Let's say the institutions push gold to take um this major liquidity level out here. Okay.
Mhm.
And it's a institutional move. It's a low liquidity move. It didn't move, it didn't leave much liquidity behind, right? But it did leave behind major liquidity down here. Okay. So what it's telling me is that once we take out, if we were to take out this 108,000 here, and let's just say we got manipulation to the downside, okay, this is going to be a relative easy move, relative easy true move to the downside. Okay, because the institution's true intentions was what? Take out this major liquidity level here, only to reverse the market and do what? Start targeting this major liquidity down here. Okay. Now,
Got
if
it.
now let's just say that the market true intent, let's just say we're in a downtrend, right?
Mhm.
We know that we got strong manipulation. Let's just say, back here somewhere. Let's just say this area is a strong manipulation area to the downside. It's a level 3 or level 4 strength of manipulation. Okay.
Okay.
And the market moves higher, right? And as the
Mhm.
market is moving higher, we know it's generating liquidity and leaving liquidity behind. Okay. We know with a high confidence that when we get to this level 3 area of manipulation, that we can take a short because the market generated and left us liquidity behind to be targeted.
And that would be considered low liquidity. Low liquidity.
That would be considered a high liquidity move because we left liquidity behind, right? But
Okay.
but ultimately, right, this was a level 3, area of manipulation. So we knew that, hey, when we got back to this level 3 area of manipulation, that this is a high probability shorting opportunity, right? Because the market left us liquidity behind to target.
Okay.
Okay.
So it's more about knowing the moves that's going on as opposed to whether it's a high liquidity or low liquidity move.
Yeah, because think about it this way: on a high liquidity move, who's currently winning? The retail traders or the institutional traders?
High liquidity, I would think retail.
Retail, right? And we're in the retail traders did what? Drive the market all the way up to what? A level 3 strong manipulation to the downside. Okay.
Hmm.
The retail traders are just piling it on, right? And we can see it in what? The liquidity that's being left behind. But when we get to the retest of this area, we can take it with high confidence because we know that what? The institutions are coming to grab the liquidity that the retail traders left behind.
Got it. Okay.
Yep.
That makes sense. Thank you.
Yep. No problem. Gary, you got the mic.
Can you hear me?
Yep, I can hear you now.
Okay, cool. So my question was already asked, but wanted to see, can you go to XAU USD? Because I got a question about uh it looked like it is set up exactly what you were talking about. I want to make sure that I'm understanding it. So on the 4 hour, I saw the last up counter before the down move and wanted to see, was this considered to be a high concentrated area of manipulation? It was right around 2168 area.
What, this one right here?
Yes.
Okay, so technically, right? This would be considered what? What would you consider that to be?
That's
Order block.
yeah,
That's
order block, but it's
It's also, and I'm gonna give you a hint, it's also a form of manipulation.
yeah,
Even though,
that's an attempted FU.
yep, it's an attempted FU, right?
Yeah.
In the form of a doji. Okay. So
Mm-hmm.
this is what our weakest level, right? This is a level 1 of what? Manipulation, right?
Yeah.
So what's your question? What are you trying to figure out about it?
So I don't know. This one, I'm sorry, this one looks weird because yours, you're on the FX Open. It looks totally different on the Owanda because
Okay.
it look on Owanda. There's a huge. It looked like it's an institutional area followed by a huge FU to the downside. So if you did XAU USD, but the Owanda market,
Let's see.
yeah, that one right there. There we go.
Okay.
Yeah. Yeah, see, I don't know why it looked totally different on them different markets.
Yeah,
But yeah,
well,
so
yeah, like different spot markets are different. So this would be in this instance, right? This
that's my institutional zone right there, right?
Yep, this is your institutional zone, right?
So
And you know it's in a confirmation that it's an institutional zone is why we retested it and rejected from it.
right. Okay.
Okay.
So that's a highly concentrated area of manipulation. So if I was trying to take trades from this area, I don't want to do nothing until price gets up to that area.
Okay. If price gets to that area, or like you haven't made a move yet, right? Has the mark from this area to the point now, has the market generated liquidity?
It has.
It has, right?
Has doji and double tops that can be considered as that.
Yeah. So you wouldn't want to take a short until this area of this last area of liquidity is broken, right? And then we get some type of manipulation or rejection to go back south.
Gotcha.
Okay.
Just making sure I'm looking at that right. Okay.
Yep. No problem.
Appreciate it, man.
Yep. Jason, you got the mic. Jason, can you hear me?
Can you hear me?
Yep, I can hear you now.
Can you hear me?
Yep, I can hear you. Okay, Tara.
Okay, you hear me now?
Yep, I can hear you.
Okay. How you doing today?
I'm good, man. How about you?
I'm all right. I'm doing pretty good. You probably answered the question already. I was asking about the on a lower time frame when you're looking at your entry, looking
Okay.
at your place of entry for the FU.
Okay.
Say if the market is going the opposite way on a higher time frame than the entry time frame, which one do you actually go by?
So the higher time frame is always going to take precedence, right? So if I got a 1 hour FU to the downside, and then all of a sudden the market forms a 5 minute FU to the upside, I'm not just going to take the 5 minute FU to the upside. Okay. When would I consider taking the 5 minute FU to the upside? I would consider taking a 5 minute FU to the upside once that 5 minute FU to the upside is retested and it holds.
Okay.
Okay.
Gotcha. Understood.
And the second part of that, Jason, is this: the 5 minute FU needs to take place, right, in a area in which the market can potentially form a 1 hour FU to the upside.
Gotcha. Okay.
Okay. So like let's just look at gold right here, right? Let's just say let's just say we go into the downside, right? I would need a 5 minute FU to form below this level right here in order to negate, right? I would need a 5 minute FU to form below this level. Okay. And I need the 5 minute FU that formed below this level to be tested in order for me to think about taking a long trade.
Okay. Thank you.
All right, no problem. All right, well, listen, it's 9:36. I appreciate y'all time. I hope you were able to take something from the class tonight. Tomorrow we'll be back again at 7:30. And we're gonna be putting this all together in our trading plan and developing our roadmap and our process for our path to consistently profitable trading. All right, I appreciate you all. You all have a good night. Happy trading. I'll see you all tomorrow. Okay.